Welcome back to Good Day Alabama, everyone. The time, 7:23. In Money Tuesday, it's a sign of the times. Historically low interest rates. The Fed has kept the rates down to stimulate the economy. For many retirees, though, those low rates have wreaked havoc on their bottom line. These are people who depend on interest from their investments to pay the bills to live in retirement. Financial planner Stuart Welch offers a solution for those feeling the pinch right now. It's good to see you today.
Good morning, Rick.
Okay, but that's kind of the setup for folks. A lot of, we've heard these stories, but that's one of the kind of unintended consequences, I guess, to those low interest rates.
Rick, it has been huge. All of these people that are depending on interest income for as retirees have all of a sudden, when they've had CDs mature, now they can't get any interest rate on it. So it's been a big problem for them.
Okay, you're talking about convertible bonds. I mean, you say this is one vehicle that folks may want to consider, right?
Well, it is one that a lot of people are looking at. So everybody's looking at everything. Where is it I can get interest and have some upside? And a convertible bond is essentially a bond issued by a corporation where they also give them the option to convert it to shares, a certain number of shares of stock at a certain price. And so a lot of bondholders will look at that and say, gosh, if I can get 3 or 4% and have the option to convert to the stock later at a higher price, then I've got the best of both worlds.
And you say any number of corporations offer these types of convertible bonds out there. Let me ask you, because you say kind of the devil's in the details on this, because analyzing what to purchase, which ones to do, is kind of a tough task for the typical person, right?
I think it is a big task for the typical individual investor. There's so much you have to do. You have to be able to analyze corporate statements and a lot of different things. The best choice for the typical investor is going to be a fund, a mutual fund, right. And probably the oldest one is Calamos. Convertible bond fund, and also another good choice would be Vanguard bond fund, and convertible bond fund. And so these you have professional managers in there making those decisions for you, and that's probably the best way to go.
Okay, let me ask you this, because we're talking particularly about retirees, but this is not necessarily a strategy would be limited only to retirees who are in this kind of situation and trying to get more out of the interest that they live off of. Right?
Well, that's exactly right, Rick. It's convertible bonds have often been called chicken stocks, and it's like I'm a little afraid of the market, so I'm going to take a bond, I'm going to get a yield. And then have the option of converting to stock if stocks move up sharply. So the problem is if it never moves up, if the stock price never moves up enough to hit that strike price, then what you've got really is a subpar bond, because you're actually getting a lower yield than you typically would if it didn't have this option.
So that's the downside, particularly for a younger investor than for a retiree.
And I think one other thing is they tend to be very volatile, much more so than maybe a typical bond fund was. So in 2008, when the market was down sharply, these bond funds were down about 30%. That's an eye-opener. In 2009, when the market was up sharply, they were up about 30 to 40%. So there's a lot of volatility there.
All right, something to think about today. Stuart Welch, always good to see you.
Thanks, Rick.
Thanks so much for being with us. Let's go over to Mickey once again.